Imagine owning the most profitable casino in the world. The house always wins, the margins are spectacular, and the cash flow is practically a law of physics at this point.
Right, just an absolute money printer.
Exactly. But instead of pocketing that cash, the owner takes every single dollar of profit, walks out the back door, and bets it all on a single hand of high-stakes poker in the back room. I mean, that is exactly what Meta is doing right now.
It is, and it's a massive bet.
So welcome to the deep dive. Our mission today is sharp, intense, and hyper-focused. We are unpacking why Meta Platforms is positioning itself as the undisputed king of the artificial superintelligence era.
And we've got a heavy stack of sources on the table today, right?
Oh, absolutely. We're looking at Q4 2025 earnings reports, SEC filings, insider trading sweeps, EU regulatory briefs, and some really fresh market analysis from April 2026.
And look, we are stripping away the retail noise today.
Yeah.
No casual fluff about social media trends or influencer metrics.
Right, none of that.
We are strictly examining price action, capital allocation, and the structural integrity of their AI moat. Because if you are going to understand this thesis, you have to look at the data like a capital allocator.
So let's set the board for you. Meta stock is currently sitting at $671.58. That puts them at a $1.7 trillion market cap.
Which is actually down from their all-time high, right? The August 2025 peak.
Yeah, the August high was $796, but the stock just rallied 7% in a single day. The catalyst for that was the April 8th release of their new AI models.
A massive jump for a company of that size.
Truly. So if you are managing a portfolio right now or, even just building a business on their platforms, you really have to ask yourself a question. Are you looking at Meta as a mature social media dinosaur or the absolute most mispriced AI infrastructure play on the open market?
To answer that, you have to start with a war chest.
Yeah.
You cannot fundamentally understand Meta's AI ambition without first forensically examining the core advertising engine that actually funds it.
The casino itself.
Exactly. And the numbers they just delivered for fiscal year 2025, they frankly defy the standard laws of corporate physics. They posted 22% growth at a $201 billion revenue scale.
Wait, hold on. Let's pause on that scale for a second. You just don't see a top line of $200 billion growing by 22% year over year.
It's unheard of.
Right, because the law of large numbers usually dictates that growth slows down as the denominator gets that massive. How are they forcing that kind of acceleration?
Well, you have to look at the mechanics under the hood. It wasn't just raw user growth. It was a combination of 12% ad impression growth and, crucially, a 9% increase in pricing.
A 9% premium.
Yeah. That tells you they possess both massive demand elasticity and the algorithmic ability to just manufacture new premium inventory out of thin air.
But how are they convincing advertisers to pay a 9% premium? The internet is absolutely flooded with digital inventory right now.
Because they aren't selling space anymore. They're selling algorithmic certainty. It really comes down to their AI systems, specifically tools like Advantage plus ON, optimizing the return on investment for advertisers.
So it's less of a billboard and more of a trading desk.
Exactly. Think of Advantage Plus not as a traditional ad platform, but as a high-frequency algorithmic day trader for a marketing budget.
Wow.
Advertisers aren't guessing what creative works anymore. The AI generates thousands of micro-variations, tests them in milliseconds against billions of users, and only allocates capital to the absolute winners.
It fundamentally changes the unit economics of digital marketing.
Right, and that explains the profitability. If we look strictly at what they call the family of apps, so that's Facebook, Instagram, WhatsApp, Threads, that specific segment is operating at a staggering 51.6% margin.
51.6%? That is insane. They generated $102.5 billion in operating income from that segment alone.
And that cash engine is accelerating into a historic inflection point right now. Based on the April 2026 projections we pulled from eMarketer, Meta is projected to surpass Google in global digital ad revenue for the first time ever this year. The first time ever. That's a huge shift. Yeah. The forecast has Meta hitting $243.46 billion compared to Google's $239.54 billion.
Securing Meta a 26.8% global market share, so they are officially taking the crown from Google.
They are.
But here's the disconnect for me. If they have an absolute monopoly on profitable digital attention, the valuation makes zero sense. They are currently trading at a PEG ratio of 0.91 and a forward PE of 24.63.
The PEG ratio is the key there.
Right. Let's translate that PEG ratio for a second. A PEG ratio basically compares a stock's valuation to its expected earnings growth. Anything under 1.0 means the stock's price is fundamentally lagging behind its growth rate. It is literally sitting in the discount bin.
It is statistically mispriced for a growth stock of this scale. I mean, it just is. But to understand why the market is mispricing it, you have to look at the headline earnings.
The GAAP numbers.
Yeah, GAAP earnings per share came in at $23.49, which, at first glance looks like a slight decline.
Right, and that definitely spooked some of the retail algorithms. But we need to clarify that GAAP EPS figure because it includes a massive statutory tax hit.
The OBBA legislation.
Exactly. Meta was subject to a one-time valuation allowance charge under the new One Big Beautiful Bill Act. And we have to view the statutory financial reality impartially, right? It's just the law.
Right, it's a statutory reality. The OBBA legislation spiked Meta's effective tax rate for FY 2025 to 30%. That's up from roughly 12% the prior year.
That is a massive jump.
It is, but it's a one-time legislated charge. If you normalize for that tax hit and look at the underlying cash generation, their true earnings power for the year was closer to $30 per share.
Which implies roughly 25% year-over-year growth. But here's the real contrarian edge on this valuation. The market is punishing Meta for its aggregate numbers.
Blended numbers, yeah.
Right. But if you strip out Reality Labs, the metaverse and hardware division, which posted a $19.2 billion loss, the core family of apps business is trading at roughly 15 times earnings.
It is cheaper than the average S&P 500 company.
Because of the AI efficiency, not in spite of it.
Exactly. The market is effectively assigning a value of 0, or even a negative value, to a research and development division that Mark Zuckerberg can fund out of free cash flow indefinitely.
But I have to push back on this narrative. I mean, if the engine is so incredibly efficient, if it's printing cash at a 15x multiple, why did the stock crater 19% in March?
The March drop was violent, yeah.
It went from $648 down to $525 in a matter of weeks. Going back to our casino analogy, the market saw the owner walking to the back room to play high-stakes poker, and they panicked.
That panic is exactly the transition from the cash engine to the capital expenditure war.
The CapEx war.
Right. The market realized that the money printing from those AI-optimized ads is being aggressively funneled into the largest compute build-out in human history. I mean, let's look at the CapEx trajectory because it is violent.
Give us the numbers.
Meta's capital expenditure jumped from $37.3 billion in 2024 to $72.2 billion in 2025.
And their guidance for 2026? A jaw-dropping $115 to $135 billion.
Furthermore, they're altering their entire capital structure to fund it. Long-term debt doubled to $58.7 billion. They're actively taking on leverage to secure H200 and B200 Blackwell chips.
And these are the most advanced processors on Earth, requiring entirely new data center architectures and cooling systems.
Which is exactly what fueled Michael Burry's viral bear thesis in March. He explicitly stated that AI data center CapEx is, quote, out of control and unsustainable.
And that is definitely the consensus view right now. But the contrarian insight is that this CapEx isn't a reckless cash burn. It is an insurmountable brute force moat.
What's fascinating here is that the April 8th release proves it.
Right. Let's get into April 8th, because that triggered the 7% rally. They released Llama 5, an open source model with 600 billion parameters.
Massive scale.
Yeah. And they specifically highlighted its capability for recursive self-improvement. Before we get to the moat, walk us through the mechanics of that. What does recursive self-improvement actually mean for an investor?
Mechanically, it means the AI model is capable of writing, testing, and deploying better code to make itself smarter.
Without human intervention.
Without human engineers in the loop. At 600 billion parameters, Llama 5 has enough architectural complexity to evaluate its own neural pathways and optimize them. It is literally compounding intelligence.
Wow.
And alongside this, they launched Muse Spark, which is a closed-source enterprise model out of the newly formed Meta Superintelligence Labs.
Headed by their new chief AI officer, Alexander Wang.
Exactly.
Okay, so they spent $135 billion on chips to train an AI that can recursively improve itself. But here's what I don't get. They open-sourced Llama 5. They gave the state-of-the-art model away to developers for free. How do you build a moat by giving away your most expensive asset?
Well, by giving Llama 5 away for free, Meta is intentionally commoditizing the AI software layer. Think about the unit economics of their competitors for a second.
Okay.
Every other AI startup or tech giant is trying to charge a premium for access to their models, right? They have to recoup their own massive compute costs.
Right. They need subscription revenue.
Exactly. So by flooding the market with a free, state-of-the-art alternative, Meta forces competitors to bleed cash trying to compete with free.
So it's like Google giving away the Android operating system for free back in the day just to destroy Apple's software advantage and ensure everyone stayed locked into Google search.
Spot on.
Meta is giving away the AI brain so no one else can charge a premium for it, forcing everyone to compete on Meta's home turf for the advertising network.
That is the structural genius of it. Meta doesn't need to sell the model. They take Llama 5, deploy it internally, and use it to relentlessly optimize their own $243 billion ad network. They commoditize their competitor's product to fortify their own.
Here's the real question nobody's asking, though. Is this just the Metaverse 2.0 mistake all over again?
The existential fear.
Right. I mean, Mark Zuckerberg has unilateral voting control over this company. He is spending $135 billion on chips and giving the software away. What if the return on investment simply isn't there?
It is the multi-billion-dollar question. But the mechanics are fundamentally different from the metaverse.
How so?
Well, the metaverse required consumers to adopt entirely new behaviors, right? Buy expensive hardware, put clunky VR headsets on their faces.
Yeah, nobody really wanted to do that.
Exactly. But AI doesn't require a behavioral shift. It instantly improves the product billions of people already use. It makes the feeds more engaging, it makes the ads convert at higher rates. The ROI is immediate and measurable in the ad margins.
But they aren't stopping at the back-end infrastructure. Here's where it gets really interesting. They are aggressively moving to own the hardware and the consumer endpoints, creating a closed-loop AI ecosystem.
The final puzzle piece.
Yeah, if we look at the hardware data, EssilorLuxottica, the maker of Ray-Bans, reported that sales of the Ray-Ban Meta AI glasses more than tripled to 7 million units in 2025.
And they are ramping up production to 20 million units for 2026.
Right. The hardware is merely the distribution vehicle for the intelligence. The Gen 3 glasses, codenamed Scriber, will feature what Meta calls super sensing.
Super sensing is a game changer.
Explain the mechanism of that, because that sounds like a massive leap from just taking photos with your sunglasses.
It is continuous ambient compute. The AI in the glasses has real-time continuous memory of exactly what the user sees and hears.
So it's always on.
Yes. It isn't a prompt-based interaction where you pull out your phone, open an app, and type a question. The AI processes your physical environment in real time. It remembers where you left your keys, it translates conversations live, it analyzes products you look at on a store shelf.
So they are building the hardware endpoints for ambient compute, but simultaneously they are weaponizing their existing software endpoints.
WhatsApp being the primary one.
Exactly. WhatsApp has 3.58 billion daily active people. They are forcing AI assistants into the primary communication channel of half the planet, and this has triggered an immediate regulatory backlash.
We're seeing it right now. On April 16, 2026, the EU Commission announced it is slapping Meta with interim measures under the Digital Markets Act.
A DMA.
Right. The EU is demanding that Meta reinstate third-party AI assistants' access to WhatsApp.
Why are they targeting WhatsApp specifically, though?
Because Meta's AI distribution via WhatsApp is an immediate existential threat to every other AI startup on the continent. The EU is trying to prevent Meta from leveraging its massive messaging monopoly to permanently lock competitors out of the AI assistant market.
That makes sense. I mean, if Meta controls the default assistant on 3.5 billion devices, no startup can compete for user query volume.
Exactly. It chokes off the data supply for everyone else.
We also have to factor in the persistent litigation overhang here. There is a $375 million New Mexico jury verdict against Meta regarding child safety issues.
Yeah, Bloomberg called it a big tobacco moment.
Right. When you combine that with the EU fines, doesn't that drain resources and distract management from this AI build-out?
It is a tail risk, absolutely. Wall Street views the Reality Labs segment's $19 billion burn, the EU regulatory fines, and the state-level litigation as massive liabilities.
As dead weight.
But look at the contrarian truth regarding Reality Labs. It isn't a failure, it is a long-term Trojan horse.
A Trojan horse to bypass Apple and Google.
Precisely. For a decade, Meta has had to pay rent to Apple's iOS and Google's Android.
The mobile duopoly.
Right. But once AI glasses like the Ray-Ban Scriber replace smartphones as the primary computing interface, that duopoly shatters. Meta will own the hardware, the proprietary operating system, the ambient AI, and the underlying ad network.
They become the landlord.
Exactly. They collect the rent.
Which raises an incredible structural question. If Meta successfully monetizes AI business messaging on WhatsApp, while simultaneously dominating wearable compute and charging enterprise licensing fees for their closed-source Muse Spark model. Does the advertising business even need to be their main driver in 2030?
Structurally, no. They are building a diversified superintelligence utility. The advertising engine, as powerful as it is merely the funding mechanism to secure the compute necessary to build that utility before anyone else can.
So we have a company building an impenetrable hardware and software moat, commoditizing its competitors, and funding the entire operation with an ad machine operating at a 51% margin.
That's the setup.
Let's synthesize this and look at the investor action, because the tension in the boardroom right now is at an absolute peak.
Oh, the insider trading data tells two very different stories here. If you want the bear case, look at CFO Susan Lai.
What did she do?
She sold $88 million in stock across 4 trades in late February 2026.
Wow. This was right near the all-time high just before the stock crashed 19% in March.
Right. And that is the single most concerning data point for the bears.
Yeah.
The chief financial officer has total visibility into the capital expenditure trajectory, the debt load, and the potential for margin compression.
So selling $88 million right before a massive drop signals deep internal caution regarding that $135 billion CapEx guide.
It definitely signals caution. But the counterweight to that internal caution is the institutional accumulation.
From who?
Legendary investor Bill Ackman's Pershing Square just bought 2.67 million shares on that exact March dip.
That is a massive position.
He's deploying huge institutional capital based on the mathematical thesis that the core business is mispriced at a 0.91 PEG ratio, regardless of the CapEx.
And we cannot ignore the architect himself in all this. Mark Zuckerberg systematically sells stock almost every quarter to fund his philanthropy.
Like clockwork, usually.
Right. But he has completely paused his automated stock selling for 8 months. He hasn't sold a single share since the peak in August 2025.
That pause is a direct signal.
Mm.
It implies he believes the current capital expenditure cycle, specifically the deployment of the $135 billion into Blackwell chips to train models capable of recursive self-improvement, will trigger a massive re-rating of the stock once that infrastructure is fully online.
So what does this all mean for you? If you are trading the stock, if your business relies on their Advantage Plus algorithms to drive revenue, or if you're simply putting on a pair of Ray-Bans to capture a video, Meta is defining the infrastructure of the next decade.
Absolutely. By open sourcing a 600 billion parameter model, they are actively shaping the global technological standard.
Right.
They are dictating the pace and the economics of the AI arms race. Every other tech giant is being forced to react to their capital allocation.
Which leaves us with a final puzzle to mull over. If Meta's Llama 5 actually achieves true recursive self-improvement, meaning the AI can continuously rewrite its own code to expand its intelligence without human engineers, and their $135 billion budget gives them the largest, most powerful compute cluster on Earth.
The ultimate endgame.
Yeah. At what point does Meta stop being a technology company and start operating as a sovereign digital utility?
If you remember one thing, it's this. The market thinks Meta is a social media company desperately buying chips. In reality, Meta is an AI supercomputer that just happens to fund itself by selling ads.